One of America's strongest advantages was never only its army, its technology, or its stock market. It was the dollar. More precisely, it was the system that forced the world to need dollars before it could buy the most important commodity in the modern economy. Oil. If you want to understand why the United States could run enormous deficits, import more than it exported, borrow cheaply, and still remain at the center of the global financial system, you have to understand the petrodollar. And if you want to understand why gold has been moving the way it has, you have to understand why the petrodollar system is no longer as unquestioned as it once was. This is not about a conspiracy. It is about incentives. It is about how money flows. It is about how countries manage risk when they realize that the reserves they thought were safe can become political weapons. It is about what happens when the world's oil sellers start asking whether dollars are still the only acceptable settlement currency. And it is about what the most powerful institutions in the world are doing with their own reserves while ordinary investors are still debating whether gold is just an old metal. The headline is that one of America's key Gulf allies is stepping away from the old oil order and openly considering more non-dollar oil settlement. But the deeper story is not one country. The deeper story is that the machine is changing. When a machine changes, portfolios have to change with it. That does not mean the dollar is going to zero. That is childish thinking. The dollar is still deeply embedded in global trade, global finance, global debt markets, central bank reserves, corporate funding, commodities, and the world's largest capital markets. The United States still has unmatched financial depth, military reach, technological power, and institutional scale. So the dollar does not need to disappear for the investment world to change. The monopoly only has to weaken. That is the key distinction. A system can remain dominant and still lose enough marginal demand to change asset prices. A reserve currency can remain the reserve currency and still be less trusted than before. A country can remain powerful and still face a slow decline in the special privilege it used to take for granted. This is where the real risk lies. Not a sudden collapse, a slow repricing. Most people miss slow repricing because it does not feel like crisis, it feels like background noise. One country signs a non-dollar oil agreement, another central bank buys more gold, another country reduces treasury holdings, another trade bloc discusses alternative payment systems. Another sanction event reminds reserve managers that dollars and euros inside Western financial institutions are not neutral assets individually. Each event can be explained away together. They form a pattern, and markets are very good at ignoring a pattern until the price has already moved. So the first thing we have to do is understand the machine itself. The petrodollar system began after the oil shock of the 1970s. The United States had gone through a painful energy crisis. Oil producers had shown that energy could be used as a weapon. American consumers saw gasoline lines and rising prices. The United States needed a new structure to stabilize the oil relationship and preserve the dollar's global role after the end of the gold standard. The arrangement with Saudi Arabia became the center of that structure. It was not a simple contract with a clean expiration date. That is where many people online get confused. There was no magical 50-year treaty that simply expired and ended the dollar system overnight. The more important truth is that the United States and Saudi Arabia built a strategic understanding. The arrangement had three pillars. The first pillar was that oil would be priced and traded primarily in dollars. If countries wanted oil, they needed dollars. That created constant global demand for dollars. The second pillar was that the dollars earned by oil exporters would be recycled back into the U.S. financial system, especially through purchases of treasury debt and other dollar assets. This meant the United States had a large external buyer base for its debt. The third pillar was American protection. The United States gave Gulf monarchies military, political, and strategic support. In exchange, the oil system supported dollar dominance. That was the machine. Oil demand created dollar demand supported treasury demand lowered American borrowing costs. Lower borrowing costs allowed the United States to run larger deficits than most countries could run. And American military power helped secure the system. This is what economists sometimes call exorbitant privilege. It means the United States could issue the currency the world needed. It could buy real goods and energy with paper claims denominated in its own currency. It could borrow from the rest of the world at lower rates because the rest of the world needed safe dollar assets. That is not a small advantage. It is one of the greatest financial advantages any country has ever had. A normal country that runs large deficits and imports more than it exports eventually faces currency pressure. It has to raise rates. It has to cut spending. It has to defend the currency. It has to adjust. The United States had more room because the world demanded dollars. That room created power, but power creates complacency, and complacency creates fragility. When a system works for 50 years, people begin to confuse a historical arrangement with a law of nature. The petrodollar was never a law of nature. It was a geopolitical arrangement supported by incentives. When incentives change, the arrangement changes. That is what we are seeing now. The first crack is that major oil producers want more freedom. The source highlights the United Arab Emirates and its desire to produce more oil than OPEC quotas allow. The UAE has invested heavily in production capacity. It wants to use that capacity. If an organization tells a country with growing capacity to hold back production, eventually the country asks why it should stay constrained. That is an economic incentive. A country that can produce more wants to monetize its investment. But there is also a strategic incentive. The UAE has grown closer to the BRICS framework and to non-Western trading partners. China is a major customer for Gulf oil. India is a major energy consumer. The global demand map is no longer centered only on the West. If your biggest customer is China and China wants to settle more trade in yuan, the oil seller has to at least consider it. Not because the oil seller loves yuan more than dollars, because the oil seller wants optionality. Optionality is power. A country that can sell oil in dollars, yuan, rupees, or other currencies has more bargaining power than a country locked into one system. This is the first principle. Energy exporters do not want ideology. They want markets, they want buyers, they want security, they want to protect reserves, they want to reduce dependence on any single power. The dollar system used to give them the best combination of liquidity, security, and geopolitical benefit. But after years of sanctions, reserve freezes, debt growth, and geopolitical fragmentation, the calculation is changing. That does not mean the dollar disappears from oil trade. It means the dollar's monopoly weakens. The second crack is that major buyers and sellers are already experimenting with non-dollar settlement. Saudi Arabia has discussed long-term oil arrangements with China. Russia has been forced out of much of the Western financial system and has moved toward non-dollar trade. India has made payments for oil in rupees. The UAE has signaled willingness to use other currencies in some circumstances. Again, do not overstate it. The dollar is still dominant. But marginal change matters. The oil market is enormous if even a portion of global oil trade moves away from dollars. The steady structural demand for dollars is reduced, and the marginal buyer is what sets price. In markets, you do not need everyone to sell for the price to move. You need enough marginal selling to change the balance. The same is true for currencies and reserves. If every country still holds dollars but slowly holds a little less than before, that matters. If every oil exporter still accepts dollars but increasingly accepts alternatives, that matters. If every central bank still owns treasuries but buys more gold at the margin, that matters. The system changes at the margin first. Then, if the marginal change persists long enough, the structure changes. The third crack is the recycling mechanism. This may be the most important part for investors. The old petrodollar machine was not only about oil being priced in dollars, it was about oil dollars coming back into U.S. debt. Oil exporters earned dollars. They accumulated reserves, they bought treasuries that helped finance U.S. deficits. If fewer oil dollars are recycled into treasuries, then the U.S. Treasury market must rely more heavily on other buyers, domestic banks, pension funds, insurance companies, foreign allies, the Federal Reserve in crisis conditions, private investors. The problem is that the United States is issuing more debt at the same time that some historic buyers are becoming more cautious. China's Treasury holdings have fallen substantially from their peak. Some allies, like Japan and the United Kingdom, may buy more. So this is not a universal dumping of U.S. debt. But the direction of diversification is visible. Reserve managers are no longer asking only what is the most liquid asset. They are also asking what asset cannot be frozen by another government. That question changed everything. After Russia's foreign exchange reserves were frozen, this was one of the most important reserve management events of the modern era. Whatever one thinks morally or politically about the decision, the lesson for central banks was clear. If your reserves sit in another country's financial system, they are not fully under your control. They can be immobilized, they can be sanctioned, they can become part of a geopolitical conflict. That realization changed the risk calculation for countries that are not fully aligned with the West, and even for countries that are aligned but want independence. Gold suddenly looks different under that lens. Gold has no counterparty. A treasury bond is someone else's liability. A bank deposit is someone else's liability. A euro or dollar reserve account inside a foreign financial institution is exposed to the legal and political system of that jurisdiction. Gold, if held directly in your own vault, is not a promise from another country. It is an asset. That is why central banks have been buying gold at a pace not seen in modern times. They are not doing it because they watched a YouTube video. They are not doing it because they became emotional gold bugs. They are doing it because reserve diversification is now a national security issue. That is the signal. Central banks are the ultimate insiders of the money system. They create currency, they manage reserves, they understand sanctions, they understand balance sheets, they understand debt, they understand the difference between an asset and a liability. When they buy gold, you should ask why. Not because you should blindly copy them, because their behavior reveals how they see the system, and what they seem to see is a world where the dollar remains important but not risk-free, a world where reserves can be weaponized, a world where debt continues rising, a world where geopolitical fragmentation is increasing, a world where holding everything in dollars creates concentration risk. This brings us to the 3Ds: dollarization, debasement, diversification. These are the three forces behind the gold thesis. De-dollarization does not mean the dollar goes away. It means the world slowly reduces dependence on the dollar where it can. More bilateral trade in local currencies, more commodity settlement outside dollars, more central bank reserve diversification, more payment infrastructure that bypasses Western control. The dollar remains large, but the unquestioned monopoly weakens. That is enough to matter. If every country needs dollars for oil, the dollar has one kind of demand. If more countries can buy oil in other currencies, the dollar has less structural support. The second D is debasement. The United States has large deficits and a growing debt burden. Every deficit adds to the pile. When debt becomes large, the political system rarely chooses immediate pain. It prefers delay. It prefers borrowing. It prefers liquidity. It prefers inflation over austerity. That means the real value of currency can be diluted over time. Debasement does not require a dramatic hyperinflation event. It can happen slowly. A dollar buys less food, less housing, less health care, less insurance, less energy. Less labor, less everything. The number stays the same. The purchasing power falls. Gold cannot be printed in the same way. It can be mined, but its supply grows slowly. That scarcity makes it attractive. When investors and central banks worry about currency debasement, gold is not perfect. It produces no cash flow. It can be volatile. It can underperform for long periods, but as a monetary asset, it has one feature paper currencies do not have. No central bank can create gold by vote. The third D is diversification. The world is moving into a more fragmented geopolitical environment. Europe is rearming, the Middle East remains unstable. China and the United States are strategic competitors. Russia has been pushed outside the Western financial system. Trade routes are shifting. Sanctions are a major tool of power. Supply chains are being rebuilt around political risk. In that environment, concentration becomes dangerous. If a country holds all of its reserves in another country's currency and financial system, it has concentration risk. If an investor holds all wealth in one currency, one country, one asset class, and one political system, that investor also has concentration risk. Gold becomes a diversification asset. Not because it solves every problem, because it behaves differently. It is not a stock, it is not a bond, it is not a bank deposit, it is not a promise to pay. It is an asset outside the liability structure of the financial system. That role becomes more valuable when trust in the liability structure weakens. Now, what does this mean for a regular investor? First, it does not mean sell everything and buy gold. That would be emotional and undisciplined. Gold is one tool. It is not a complete portfolio. Gold does not generate earnings. It does not pay dividends. It does not innovate. It does not build factories. It does not create software. It does not hire people. It does not compound through business growth. Productive assets still matter. The United States stock market still matters. The dollar still matters. Treasuries still matter in global liquidity. But in a world of de-dollarization, debasement, and diversification, a portfolio with no gold or hard asset exposure may be missing an important hedge. The question is not whether gold is good or bad. The question is what role it plays. For a central bank, gold is a reserve asset outside another country's control. For an investor, gold can be a hedge against currency debasement, geopolitical fragmentation, and systemic distrust. That is the role. The next question is how to get exposure. One way is physical gold. Physical gold has the advantage of direct ownership. It is outside the digital financial system if held properly. It has no fund structure. It has no management fee. It has no promise attached to it. But physical gold has costs and risks: storage, insurance, security bid, ask spreads, authenticity, liquidity, the possibility of theft. The inconvenience of selling: for some investors that is worth it. For others, it is not. Another way is a gold ETF. A gold ETF is much easier. You can buy and sell through a brokerage. You do not need to store bars or coins. You can size positions precisely. Liquidity is generally better. But a gold ETF reintroduces the financial system. You own a claim through a fund structure. You depend on custodians, legal documents, and market infrastructure. That may be acceptable for many investors, but it is not the same as holding physical metal. Again, trade-offs. Then there are gold miners. Gold miners are not gold. This is extremely important. A miner is a business. It has management, costs, mines, labor, jurisdictions, energy expenses, political risk, operational risk, debt, reserves, and capital allocation decisions. Miners can act like leveraged exposure to gold because when the gold price rises, a miner's profit margin can expand significantly if costs remain controlled. If gold rises from $2,000 to $2,500 and a miner's cost is $1,400, the margin expands materially. The stock can move more than the metal, but leverage works both ways. If gold falls, or costs rise, or a mine has problems, or the government changes taxes or management makes bad decisions, the stock can fall hard. Miners can underperform gold for years. So miners are not the same as a store of value allocation. They are equity risk tied to the gold cycle. They may offer more upside. They also carry more risk. A disciplined investor distinguishes between gold as a hedge and miners as a leveraged trade. That distinction matters. The source mentions Newmont as an example of a miner that may have lagged the gold move and could become interesting if conditions align. That is a typical miner setup. Sometimes gold rises first. Miners lag. Then if investors believe margins will improve, miners can catch up. But the timing is difficult. You need risk management. You need to understand the business. You need to avoid assuming that every miner will follow gold perfectly. Now, the broader point is portfolio construction. A portfolio for this new era should not be built around one asset. It should be built around the idea that the old monetary order is becoming less stable and less one-dimensional. That may mean owning productive companies with global pricing power. It may mean owning some gold. It may mean owning real assets. It may mean reducing excessive dependence on long-duration nominal bonds. It may mean thinking carefully about currency exposure. It may mean understanding that cash in one currency is not the same as safety. It may mean holding some assets that cannot be printed. This is not fear, it is balance. The world is not ending. The world is changing. A good investor does not need collapse to make money. A good investor needs to understand how capital flows are changing and where the incentives are pushing institutions. Central banks buying gold is an institutional signal. Oil producers considering non-dollar settlement is an institutional signal. China reducing treasury exposure is an institutional signal. BRICS countries discussing alternative settlement systems is an institutional signal. India paying for some oil in rupees is an institutional signal. Russia's frozen reserves were a shock to institutional reserve managers. These signals point in the same direction. The dollar system is still dominant, but it is no longer unquestioned. That is the key. Now, let us think through the American side. The petrodollar helped America because it created persistent global demand for dollars and treasuries. If that demand weakens, the U.S. government may face higher borrowing costs than it otherwise would. It may need more domestic buyers. It may need the Federal Reserve to play a larger role during stress. It may face more pressure to inflate away debt. It may still remain powerful, but the cost of maintaining the system rises. That connects directly to debasement. If deficits continue and foreign demand for treasuries weakens at the margin, then the system has a few choices. Raise rates enough to attract buyers, cut spending dramatically, raise taxes dramatically, allow more inflation, use central bank balance sheet expansion in crisis. The politically easiest path is often inflation and financial repression. That means holders of cash and fixed nominal claims can lose purchasing power. Gold does not solve all of that, but it can be part of the response. Now, we should be careful about claims. The dollar is not going to be replaced tomorrow by the yuan. The yuan has its own problems. China has capital controls. Its legal system is not trusted in the same way by global investors. Its financial markets are not as open or deep as U.S. markets. Many countries do not want to move from dollar dependence to yuan dependence. So de-dollarization is not simply dollar out. Yuan in, it is more complex. It may be dollar dominance slowly diluted into a more multipolar reserve system. More gold, more bilateral settlement, more local currency trade, more regional payment systems, more use of commodities as reserve anchors, more diversification rather than one clean replacement. This is why gold benefits. Gold is neutral in a way no national currency can be. The euro has Europe's politics. The yuan has China's controls. The yen has Japan's debt. The pound has the United Kingdom's constraints. The dollar has U.S. debt, sanctions, and political risk. Gold has no central bank. That does not make it perfect. It makes it different. And different is valuable when correlations and trust are changing. The key is not to become ideological. Gold bugs often become too emotional. Dollar defenders often become too dismissive. Both can miss the nuance. The dollar can remain powerful. Gold can still rise. America can remain the largest financial market. Central banks can still diversify away from dollars. Treasuries can remain important. Foreign buyers can still reduce their share. These ideas are not mutually exclusive. A complex system can contain all of them at once. That is why the investment answer should be balanced. Now, what about the timing? Gold has already moved significantly. After a big move, investors often feel that they missed it. Sometimes they did. Sometimes the move is only the first stage of a longer repricing. The answer depends on whether the underlying forces continue. Are central banks still buying? Are real rates favorable or unfavorable? Is the dollar weakening or strengthening? Are deficits improving or worsening? Are oil producers moving further toward non-dollar trade? Are geopolitical tensions rising or falling? Are investors underallocated or overallocated to gold? Are miners catching up or still lagging? These are the questions to watch. Do not buy gold just because it went up. Do not reject gold just because it went up. Ask whether the structural forces remain intact and whether the price reflects them. That is the disciplined approach. The same applies to miners. If gold rises and miners lag, there may be opportunity, but only if margins, balance sheets, mine quality, management, and valuation make sense. A miner with poor costs or political risk may still disappoint, even in a gold bull market. The metal is simple, the business is not. This is why a regular investor must decide how much complexity they want. Physical gold is direct but inconvenient. Gold ETFs are convenient but financialized. Gold miners offer leverage but are businesses with operational risk. Royalty and streaming companies may offer another model, often with less operating risk than miners, but still tied to the sector. Each has a role. Each has a risk. A good portfolio chooses intentionally. Now let us return to the three-step framework from the source. Step 1 is understand the machine. The petrodollar machine turned oil demand into dollar demand and dollar demand into treasury demand. It allowed the United States to finance deficits more cheaply and maintain global power. If you do not understand that machine, you cannot understand why oil settlement matters. Step 2 is identify the cracks. Oil producers want more freedom. Major buyers want non-dollar settlement options. Reserve managers are reducing concentration in dollars and treasuries. Sanctions and frozen reserves changed the risk model. The recycling of oil dollars back into U.S. debt is less automatic. Step 3 is follow where powerful institutions are putting money. Central banks are buying gold, not perfectly, not every month in the same amount, not every country. But the direction is clear. The most powerful monetary institutions are increasing gold's role in reserves. That is the signal. Once you see the framework, the gold move becomes easier to understand. Gold is not rising only because retail investors are scared. It is responding to a structural shift in how states think about reserves, currency risk, and sovereignty. That is very different from a temporary trade. Now, if I were thinking as a long-term investor, I would ask what this means for asset allocation. First, I would not hold all wealth in cash. Cash is useful for liquidity, but not for long-term purchasing power if deficits and debasement continue. Second, I would not assume treasuries are risk. Free in real terms, they may be safe nominally, but inflation can reduce real returns. Third, I would own productive assets, companies with pricing power. Global revenue and strong balance sheets can adapt to currency debasement better than cash. Fourth, I would consider some allocation to gold or gold-linked assets as a hedge against monetary and geopolitical risk. Fifth, I would avoid overconcentration. No single thesis should dominate the portfolio. The point is resilience, not prediction. Now, let us think about what could make the gold thesis wrong or weaker. If the dollar strengthens significantly and stays strong, gold can struggle. If real interest rates rise materially, gold can become less attractive because gold pays no yield. If central bank buying slows, a major support can weaken. If geopolitical tensions fall and trust in the dollar system improves, gold's urgency can decline. If miners face rising costs, their stocks may underperform even if gold holds up. If investors crowd too aggressively into the trade, the short-term risk of pullbacks rises. This is why risk management matters. No thesis is immune to cycles. Gold can rise structurally and still fall tactically. An investor must size exposure so that volatility does not force a bad decision. This is especially important because gold does not produce cash flow. A business can become more valuable because earnings grow. Gold's value is more dependent on monetary trust, real rates, central bank behavior, and investor demand. That makes it different from equities. It is a hedge, not an earnings machine. Use it accordingly. Now, the source also implies asymmetric opportunity. Asymmetry means the upside may be much larger than the downside if the thesis is right and risk is controlled. Gold miners can sometimes offer this because they lag gold and then reprice sharply when investors realize margins are expanding. But asymmetry is not automatic. It requires entry price, catalyst, balance sheet strength, and timing. A miner that already moved dramatically may no longer be asymmetric. A miner with weak execution may never respond. A miner in a risky jurisdiction may be cheap for a reason. So if someone wants more aggressive gold exposure, they need to do more work. That is the rule. The more potential upside you seek, the more work and risk management you need. There is no shortcut. Now, let us step back and look at the historical arc. The old monetary order was built after World War II and then reshaped after the end of Bretton Woods. The dollar was no longer backed by gold, but the petrodollar system helped create a new form of backing. The world needed oil. Oil needed dollars. Therefore, the world needed dollars. That was incredibly powerful. But today, the world is changing. Energy buyers are more diversified. The Gulf is more multipolar. China is larger. India is larger. Russia is outside Western finance. Sanctions are more visible. U.S. debt is larger. Gold reserves are being rebuilt. Alternative payment systems are being discussed. This does not erase the old order overnight. It erodes the monopoly. And when monopolies erode, the old pricing relationships change. The United States can still be dominant, but dominance with more competition is different from dominance without competition. That is the new environment. Investors must adapt. The investor who says the dollar is finished is likely too extreme. The investor who says nothing is changing is likely too complacent. The truth is in the middle. The dollar remains central, but the marginal flows are shifting. Gold is reacting to those marginal flows. That is the practical insight. Now let us talk about why this matters to ordinary people. Most people do not trade oil. Most people do not manage central bank reserves. Most people do not own treasury portfolios large enough to move markets. But everyone lives inside the monetary system. If the dollar loses purchasing power, your grocery bill changes, your rent changes, your insurance changes, your retirement plan changes, your savings change, your investments change if foreign demand for US debt weakens. Interest rates can be affected. If rates rise, mortgages, credit cards, business loans, and government interest costs are affected. If the government responds with more liquidity or inflation, asset prices and purchasing power are affected. If central banks buy gold, the price of gold and related assets can be affected. Macro eventually reaches the household. That is why understanding the petrodollar is not just intellectual curiosity. It tells you why the United States could live the way it did, and it tells you what could change if that privilege declines. The most dangerous financial mistake is to assume the future will look exactly like the past, because the past lasted a long time. Long-lasting systems can change slowly at first, then suddenly enough for people to notice. A good investor studies the slow phase, that is when positioning is still possible. Once everyone sees the sudden phase, prices have often already moved. This is why central bank gold buying is important. It is the slow phase signal, not panic, not collapse, steady accumulation. The institutions closest to the monetary system are adding an asset outside the monetary liability system. That is not noise. Now, what should the investor not do? Do not become a doomsday speculator. Do not sell productive assets simply because gold has a strong thesis. Do not assume gold miners are safe. Do not ignore valuation. Do not confuse short-term headlines with long-term structure. Do not build a portfolio around fear. Fear creates bad timing. The right approach is not fear, it is diversification based on a changing world. Own assets that can grow. Own some assets that can hedge, keep liquidity, avoid excessive debt, think in purchasing power, watch what institutions do, not only what they say. That is how you stay rational. Now, let us examine the difference between gold and Bitcoin, because many investors ask this in the current environment. Both are sometimes described as alternatives to fiat currency. Both can respond to distrust in government money. Both are scarce in different ways, but they are very different assets. Gold has 5,000 years of monetary history. Central banks own it. It is physical, it has no issuer, it is slow, heavy, and boring. That boring quality is part of its appeal. Bitcoin is digital, newer, more volatile, and not held by most central banks as a reserve asset in the same way. It may have a role for some investors, but it behaves more like a high volatility risk asset and digital scarcity trade. The source focuses on gold because central banks are buying gold, not because gold is exciting. Institutional reserve behavior matters. Central banks are not chasing memes. They are managing sovereign risk. That does not mean Bitcoin has no place. It means gold's role in this specific framework is different and more directly tied to reserve diversification. Now let us return to oil. Oil priced in dollars created constant demand for dollars. But if major producers increasingly accept non-dollar payment from major customers, two effects occur. First, dollar transaction demand weakens at the margin. Second, reserve composition may slowly shift because oil exporters may no longer receive only dollars and may no longer recycle the same share into treasuries. The second effect may be more important than the first. If oil exporters receive more yuan, rupees, or other currencies, they must decide what to do with them. They may spend them on imports, they may convert them, they may use them for bilateral investment, they may buy gold, they may diversify reserves. This reduces the automaticity of the old system. Automatic demand is powerful. Discretionary demand is less reliable. The old petrodollar system gave America automatic demand. The new system may require America to compete harder for capital. That means higher real yields, stronger policy discipline, or greater use of central bank support may become necessary over time. Each path has consequences: higher yields, pressure debt, and the economy. Policy discipline is politically hard. Central bank support risks inflation and debasement. Gold benefits from the uncertainty around those choices. Now, one might ask why the world would move away from such a liquid system, because liquidity is not the only objective. Sovereignty matters, political risk matters, sanctions risk matters, strategic alignment matters, trade relationships matter. If a country fears that its dollar reserves can be frozen, it may accept less liquidity in exchange for more control. That is exactly why gold becomes attractive. Gold is less convenient than treasuries. It does not pay interest, it costs money to store, but it cannot be frozen by a foreign central bank if held domestically. That feature becomes valuable when geopolitical risk rises. So the trade-off shifts. In a peaceful, integrated world, treasuries look superior because they are liquid and yield-bearing. In a fragmented, sanction-heavy world, gold becomes more valuable because it is neutral and outside another country's liability structure. That is the framework. Now, for an individual investor, the same principle can be scaled down. A brokerage account is convenient. A bank deposit is convenient. A treasury fund is convenient. A gold ETF is convenient. Physical gold is less convenient but more direct. Each sits at a different point on the convenience control spectrum. The more convenience you want, the more you rely on institutions. The more direct control you want, the more responsibility you take for storage, security, and liquidity. There is no perfect answer. There are trade-offs. That is why portfolio construction is personal. Now, let us think about miners again. If gold continues to rise because of central bank demand and monetary distrust, miners may eventually respond strongly, but miners also face costs that can rise with inflation, labor, energy, equipment, permitting, environmental compliance, and capital spending. A gold miner is not automatically a winner in gold inflation. Margins matter. If gold rises but costs rise just as fast, profits may not expand. The best miners are usually those with good reserves, low costs, strong management, safer jurisdictions, disciplined capital allocation, and manageable debt. A poor miner can destroy value even in a gold bull market. So if you use miners, use a framework: gold price sensitivity, cost structure, reserve quality, jurisdiction, balance sheet, management, valuation, technical setup. If you trade risk control, do not buy just because the word gold appears in the name. Now, the source mentions that some countries may sell gold temporarily due to liquidity needs or regional shocks. That is important because even in a structural bull case, there can be short-term selling. Countries may need dollars, they may defend currencies, they may respond to crisis, they may rebalance. Structural demand does not eliminate tactical supply. That means gold can have pullbacks. Those pullbacks are not necessarily thesis breaking if the longer-term drivers remain. This is why you must distinguish between noise and signal. Signal: central banks diversifying reserves over years. Noise: one country selling in a liquidity squeeze. Signal: oil settlements slowly becoming more multipolar. Noise: one headline about one contract. Signal: U.S. deficits and debt trajectory. Noise: one monthly inflation print. A good investor watches the signal. Now, what would invalidate the broader thesis if oil trade reconsolidated firmly around the dollar and non-dollar settlement attempts faded? If U.S. fiscal deficits narrowed meaningfully and debt sustainability improved? If central banks stopped buying gold and returned aggressively to treasuries? If geopolitical fragmentation reversed and trust in Western reserve custody increased? If real interest rates rose high enough to make gold unattractive compared with yield-bearing assets? If the dollar regains structural demand from new sources that offset petrodollar weakening, those developments would weaken the thesis. Until then, the trend deserves attention. Now, we should also talk about the danger of marketing. Whenever gold rises, many people sell fear. They say the dollar is dead. They say collapse is imminent. They say only gold will save you. That is not analysis. That is emotional salesmanship. The dollar is not dead. The United States is not finished. Gold is not a magic asset. A portfolio made entirely of fear is usually fragile in a different way. At the same time, dismissing gold as a barbarous relic is also lazy. Central banks are not buying a barbarous relic for entertainment. They are buying an asset that serves a specific function in a world where trust has weakened. The truth is more subtle than the marketing. Gold is not everything. Gold is not nothing. It is a monetary hedge whose relevance increases when de-dollarization, debasement, and diversification accelerate. That is the balanced view. Now let us bring the entire structure together. The petrodollar system gave the United States a monetary advantage by linking global oil trade to dollar demand. That system helped support Treasury demand and American deficits. Major oil producers and buyers are now exploring more non-dollar settlement. Some countries are reducing Treasury exposure or diversifying reserves. The freezing of Russia's reserves taught central banks that Western-held reserves carry political risk. Central banks responded by buying gold aggressively. The three forces are de-dollarization, debasement, and diversification. Gold benefits because it is scarce, neutral, and not another country's liability. Investors can respond through physical gold, gold ETFs, miners, or broader hard asset allocation, but each method has different risks. The dollar remains dominant, but dominance is no longer the same as monopoly. That is the real story, not collapse transition, and transitions are where portfolios must adapt. If the world is moving from a dollar monopoly toward a more fragmented reserve structure, the investor who holds only dollar-denominated financial claims may be more exposed than he realizes. If the United States continues running large deficits and debasing purchasing power, the investor who holds too much cash may lose slowly. If central banks continue buying gold, the investor who ignores gold entirely may be missing a major institutional signal. But if the investor goes all in on gold, he may be ignoring the continuing power of productive assets. The answer is balance. A resilient portfolio in a shifting monetary order should not depend on one single future. It should be able to handle dollar strength and dollar weakness, inflation and disinflation, market booms and market crashes, geopolitical stress and periods of calm. That is what all-weather thinking means. Gold can be part of that. Productive businesses can be part of that. Cash can be part of that. Bonds can be part of that. If used carefully, real assets can be part of that. The mix matters. The principle matters more. Do not assume yesterday's monetary system will protect tomorrow's wealth. In exactly the same way, do not assume the dollar's past privilege is permanent. Do not assume gold is useless because it does not pay interest. Do not assume gold is perfect because it has risen. Do not assume central banks are buying randomly. Do not assume oil settlement headlines are meaningless. Watch the machine, watch the money flows, watch the reserve behavior, watch the incentives. That is how you understand the shift before it becomes obvious. And when it becomes obvious, many of the prices may already have moved. The opportunity is not in screaming that the dollar is dead. The opportunity is in understanding that the dollar's monopoly premium is being questioned, and that assets outside the dollar liability system become more valuable when that questioning spreads. That is the essence. The world is not ending. The old oil dollar machine is being renegotiated. Gold knows it because central banks know it. And the investor who understands why can prepare without panic.